Julie, let's start with a brief recap of the stock and bond markets for 2019 and what you see for 2020.
2019 was a stellar year for both stock and bond market returns. The S&P 500 index total return was 31.5%, and the Barclays Aggregate Bond Index was up 8.7%. I believe 2020 could persist higher as equity valuations benefit from stable low interest rates. I see bond prices remaining relatively flat, with most of the return coming from the coupon payments. Of course, the 10-year Treasury is at about 1.55%. It's already lower by 30 basis points since the beginning of the year, in particular due to concerns about global growth given the coronavirus outbreak. That said, this is very much a liquidity-driven market that is proving to be persistent. I also see companies that have financial flexibility, a strategic competitive advantage, and technology sophistication capable of becoming more valuable relative to weaker competitors in 2020. I see everyone as potential beneficiaries of this economic disruption and resilience.
What do you see as the primary economic themes for 2020?
The first theme that I see is fiscal and monetary policy hesitation. The second theme I see is modest yet continued economic growth. And finally, the third theme I see is a widening gap between the haves and the have-nots of corporate America.
So let's break this down. What causes policy hesitation?
With rates so low, the Federal Reserve has limited flexibility. If a recession were in the offing, with the federal funds rate at 1.5 to 1.75%, there is limited downside flexibility. Should the Federal Reserve raise rates, we have already seen how it can slow a modestly growing economy. Fiscal policy is limited as well. $23 trillion in total public debt constrains U.S. government flexibility, as does the nearly $1 trillion annual deficit the U.S. is running. I say policy hesitation due to the limited flexibility in fiscal and monetary policy. Policy is tending to be reactive to circumstances.
Why is national debt affecting economic growth?
Think of your personal balance sheet and spending money that you don't have. In essence, you would be buying ahead of your capacity to pay. You buy, pay interest on the money borrowed, and theoretically spend less later because you purchased ahead. Importantly, the interest you are paying substitutes for other purchases. Interest does not add to economic growth directly. It's investment and consumption that add to growth. So growth has been pulled forward, and on the back end, whether by demand or financial capacity, growth slows. The same can be said for the U.S. government, only in this case, the government is not cutting its spending to pay back the debt. It is instead borrowing that much more. Studies on the history of sovereign debt show that at about 90% debt to GDP, interest costs tend to hinder potential growth. Total U.S. public debt has surpassed 90%.
When you spoke about a widening gap between the haves and the have-nots, how do you see technology and associated tech giants like Amazon affecting the U.S. economy?
Amazon has disrupted the retail industry in such a spectacular fashion that the entire landscape has shifted. The Amazon effect has forced brick-and-mortar stores to invest in home delivery in addition to in-store delivery. This is called omni-channel delivery. Amazon's Prime delivery and those companies with efficient omni-channel delivery are creating an enduring competitive advantage. What Amazon has done to the retail industry, we see happening across many industries. The blending of humanity and technology, or humology, is taking hold in a way that will change the competitive corporate landscape completely. It is not only the technology to operate more efficiently and provide consumer choice, but also the data that is collected for future use that is creating an enduring gap.
You've talked about everyone and every class as potential beneficiaries of economic disruption and resilience. Only companies without financial capacity and vision, or individuals not connected to technology, become losers. What national or international events could change your opinion?
Technology innovation, while disruptive, can, in the end, enable overwhelmingly positive outcomes, and very broadly. One classic example is the cell phone. That has enabled emerging economies to leapfrog expensive infrastructure that was required for landline phones. Technology can enable solutions to problems such as global warming through, for example, finding ways to reduce carbon dioxide output and to invent new modes of transportation. It does also require leadership that is ethical and acts with integrity. Leadership matters in decision making and has a broad impact on the American public and the world. So yes, corporate actions as well as sovereign actions could lead me to change my opinion. Geopolitical events and destructive choices can change our increasingly fragile world. Take, for example, the current coronavirus outbreak that is now a world emergency. Could it lead to a recession? Yes, but not likely. It is more likely to be highly disruptive to commerce, consumption, and the supply chain, and tragic in terms of lost lives, and ultimately transitory to economic growth. China currently accounts for about 10% of global gross domestic product. A 2% full reduction in China's estimated 2020 6% growth rate would reduce estimated global growth from about 3.3% to the range of 3 to 3.1%. The risk really lies in the unintended consequences of the disruption, and thus leadership matters.
Thank you, Julie. What closing thoughts do you have for us?
In summary, I would say there are many U.S. companies and global companies that are solving some really important economic problems that we have around the world today. The key as we look at the world going forward is how governments interact with those companies to enable broad, positive outcomes from some of the technological developments that are happening right now.
Thank you so much.
My pleasure.